Good day, fellow investors. The new JPM Guide to Markets for this quarter is out, and it's usual that we take a look at the information and discuss what's going on. And it is my opinion that what the numbers show isn't really what's going on for long-term investors. So let's start with the first topic, the market, and I think that Wall Street is a bit too exuberant, but that is their job. And if you look at what are the real corporate earnings, so 2022, we are at below 200 points. The analyst estimates 2 years ago when we were looking at this was that earnings will be at 250, right? This gap, it's what didn't happen. But when you look at analyst estimates, earnings will go from the current 190 whatever to 275 in 3 years, 2.5 years now, 23, 24, 25. So this is absolutely crazy, but this is the bullish expectations that analysts always have. Now, this green columns are earnings recessions, right? And if I calculate right, I have 1, 2, 3, 4, 5, 6 earnings recessions in the last 30 years. So every 5 years there is a recession. Why analysts never project a recession here of earnings? No, their earnings always go up. So be careful with that. And then always using the forward P/E ratio, because if you look at projections, everything goes higher, so everything looks cheaper if you use the P/E ratio from 2030 after 10% growth forever. Okay, that is something they need to do to sell to their clients, but that's not something that we as investors need to buy. When it comes to just the index, the top 10 makes the index very skewed. Higher P ratios, everything. The remaining is a little bit more, let's say, accustomed to historical norms, but still, again, the remaining historically averages are also lower. But the top 10 stocks are 32% of the market cap. It used to be 15, 16, 20. Dot-com bubble, okay, but dot-com bubble and then all those big names, whoop. What can I say? That's life. While the earnings contribution is not 32%, it's 21%. So that is a discrepancy because yes, the world, Nvidia's, the everything will change the world. Again, something I don't need to buy. I can live without buying that story, especially the info tech that is out there. And then again, if you look at the exposure to world, it is United States, all the money goes there, and the rest is not that interesting for investors. We'll discuss about investing there, but that is not also straightforward. Topic 2, the economy. There is no growth in the economy, but everyone is showing standard, slow and steady growth forever. And I think that the last 50 years, the market and everyone thinks it will all be the same. The last 50 will replicate in the future. Oh boy, we are in for a rude awakening. So, everyone expects 2% growth, real GDP growth, slow and steady. Nothing wrong with it. We'll later touch on government and spending and how that affects growth, but for now, let's look at the general projections. And 2023 is not as green as earlier years. It's starting to go more into the orange, so a little bit more sluggish, which is also logical with higher interest rates, and you can see how that inflation is going down, which is okay. Interest rates to curb inflation are high, but the expectation is that these interest rates will go down significantly, and that is the reason why stocks are, let's say, exuberantly priced. If this doesn't happen, if this happens, the stock market crashes 50%. That's something investors need to know, because it's different to estimate and value something with an interest rate of 2% and 5%. Then when it comes to interest rates, again, look at our reality. Now we have high interest rates, etc. But if you look at real yields, so nominal yields minus inflation give you real yields. At the current moment, even with 5%, the real yield is nothing. And that has been so. Nothing real means free money. Everyone has been living in an environment of free money for the last 12 years. Historically, it has been different. Only here, with the high extreme inflations of the 70s, and you can see here one inflation, then it stabilized, second inflation, and then only when Volcker put the hammer down and said enough, with interest rates going to 20%, only then it's subdued. So people think 2% inflation, everything's stable. I think it will be like this for the next 5-10 years. And here are the expectations. Everyone is buying those long-term bonds to lock in the long-term higher yields, because yields will go back where those were just 2 years ago. So if you can lock in this, you're a rich man. If that happens, that's always a risk. For now, the Fed is taking away money from the table, okay, and slowly we are now in negative money on the table territory, and we'll see how that evolves over time. But inflation is still in the red, still there, especially in Europe, a little bit around the world, India 7%, and inflation didn't go anywhere. Plus, if you look at inflation, Ole Wayne, Iowa, I think. I just went to look somewhere for houses. So price cut, foreclosure, a house for sale, foreclosure, a house 90,000, 94,000. Also this gets into inflation. Does this matter? Much less than if you want to buy something where prime real estate, etc. So also when it comes to inflation, there are ups and downs which are just ending up in one number at the end. But inflation is much higher than we see it. Of course, if you want to live anywhere, then it is cheaper on average real estate. But most people want to live somewhere else. So that all balances out, and at the end inflation is just a number. Economists and monetary policy strategists and everyone is basing their decisions on a number that is by definition and by start completely wrong. So that's also the craziness of this world, but okay. Number 3, more craziness. The government is a Ponzi scheme. Everyone tried to be a government Ponzi. You don't know it because no government that did that survived in history. So you just need to read history to understand it. But who is crazy here? Total government spending, 6.2 trillion. Sources of financing, 4.8 trillion. Borrowing, 1.4 trillion. 23% of the spending is borrowed. 23%. 23%. So if I cut this into, 5, this is on borrowed money, this growth. This is 3%. If they expect 2% growth, minus 3% that is on borrowed money, the actual economic growth is -1 for the US, even lower for Europe. So there is no economic growth, my friends, because it's not really growth when you're growing on borrowed money. And the forecast is that the borrowing will never stop. It will go on forever because we can do that, no problem. That can be done. Okay, they believe it, and they believe that growth will go further. This isn't real growth. the reality is that this is very, very risky, and all those governments that printed money to solve their debt issues, etc., didn't end up well in history. And maybe you never lived in such an environment, but I have been a billionaire when I was 5 years old, when I was 9 years old. So billionaire, 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 because when money becomes worthless, we are all billionaires. And if you want to print money to solve your debt issues and you think you will grow, sooner or later, it's good for lighting fires and heating on wood that you chopped from the woods, because there won't be other. Now, on a brighter note, international and not as easy as you would wish. Of course, the first thing that's very interesting, everyone was saying China is doomed, everything disaster. It's growing at 5.5% for the first 6 months of 2023. Well, I think China, people weren't eating anymore. The famine was from the 1960s there, from the headlines and everything, but 5.5%. Okay, real estate is going down a little bit, okay, but the numbers, it seems that people are still alive in China. Okay, then if you look at valuations, very, very cheap there. So compared relatively to others. But I think that it is much more likely that these valuations will catch up with these valuations than that these valuations will catch up with these valuations. That's why I'm not saying that it is just straightforward, put your money into emerging markets and that's it. Of course, you will find more opportunities if you look here rather than here. But then again, it depends on the risk reward you are willing to take. Global economic activity momentum, Europe is very bad, a little bit better for the others. And then drivers of inflation going forward, expensive to invest, you need to know what you're doing, but the likelihood that this will lead to inflation, especially in the developed old world, in the next 10-20 years is very high. Conclusion, I wish I could predict the future, but you know that I can't. I'm just discussing here, okay, with all the risks out there, is it worth to hold companies at P ratios of 30? That game, it might last another 7 years, but the longer you think you can play that game, the riskier it gets. And personally, I would think more of trying to find real assets to whatever happens, I'm okay situation, than chasing gains or being greedy at this moment in time. We have had zero interest rates for 15 years. Who made the money? You made the money. If you didn't make the money and now you want to make money, you are in very, very risky positions with all the building risks that nobody wants to talk about, but Ray Dalio is completely correct. The numbers show we are at the end of a long-term debt cycle, and when will that be? Tomorrow, 10 years, 15 years from now? It's impossible to know, but in the 100 years of the cycle, we are somewhere near the end, which will then lead to a lot of repercussions. Again, I can't predict when. So, thanks for watching. A little bit darker note here, but it's important to know the risks and then adjust your money investments life to those risks. Everything will be fine, don't worry. But just know what can happen and be ready whatever happens.